The New York Stock Exchange lost 22.6% of its market capitalization in a single day. Ironically, the greatest market crash in history was triggered by overconfidence in cutting-edge technology. On October 19, 1987, the Dow Jones Industrial Average plummeted 508 points. Over $500 billion vanished from global markets. Yet, this devastating panic was accelerated by a seemingly clever mechanism. In fact, hidden within this failure are structural causes that resonate with today's AI and algorithmic trading. What exactly was the catastrophe brought about by blind faith in a system? In this video, we will explore from three perspectives: why advanced technology led to collapse, what was overlooked, and the lessons for the modern economy. Now, let's delve into the full story of Black Monday, which shook the global economy overnight. The main feature also provides a detailed explanation of government responses and market recovery. In the 1980s, the United States, under President Ronald Reagan's Reaganomics, was experiencing the peak of its economic growth. Tax cuts and deregulation stimulated corporate activities, and the labor market boomed. Stock prices consistently hit new record highs, day after day. Investors believed this economic prosperity would last forever, and an optimistic mood enveloped everyone. Amidst this, a wave of computer technology swept through financial markets, rapidly advancing trading efficiency and speed. This was an innovation that processed vast amounts of data instantly, enabling trades at a level impossible for humans. On Wall Street, computers were welcomed as magical tools creating new wealth, and everyone was convinced the market's future was bright. This wave of IT brought a revolutionary method to the financial industry: program trading. Among these, portfolio insurance, which automatically hedged against stock price decline risks, garnered particular attention. This system was designed to automatically sell stocks in the futures market when the market showed signs of decline, thereby minimizing losses. In theory, it was hailed as a magic wand that could generate stable returns while managing risk. Many institutional investors adopted this system, and in its early stages it indeed generated high returns, seemingly proving its effectiveness. The market was booming, and everyone was thrilled by the arrival of a new era brought by computers. So far, so good. Everyone believed a smarter, more efficient market had been achieved. However, no one fully understood the immense impact this system would have on the market. Overconfidence in the system deepened, with many funds adopting portfolio insurance. The entire market began to rely on this automated trading. Market liquidity also decreased. As some transactions previously handled by humans shifted to systems, the market's ability to respond to fluctuations declined. Furthermore, the U.S. trade deficit was expanding, raising concerns about a weaker dollar. The macroeconomic climate also grew uncertain, with Germany hinting at interest rate hikes. Portfolio insurance, originally intended to curb stock price declines, was beginning to exert power that could alter the entire market's direction. No one realized that the system everyone believed to be safe was, in fact, introducing new vulnerabilities to the market. Market signals were being confused with system-specific noise, and the ability to accurately assess danger was fading. But here, a trap no one noticed lay open. What would happen if multiple portfolio insurance systems triggered simultaneously? No one had anticipated it. When the market declined, program trading automatically triggered sales, which led to further declines, prompting the system to trigger more sales. This negative feedback loop, bypassing human emotion or judgment, mechanically and rapidly took over the market. Even when humans noticed the market anomaly and tried to intervene, their judgment was too slow against the overwhelmingly fast system. Furthermore, like the Concord fallacy, the decision to halt a system in which enormous costs had been invested was psychologically difficult. Market participants were swamped with conflicting information about what was happening, leading to growing panic and distrust. The panic of human psychology combined with the automatic reactions of the system in the worst possible way, plunging the market into an uncontrollable state. Then came the fateful Monday, October 19, 1987. As soon as the market opened, intense selling pressure overwhelmed Wall Street. Portfolio insurance systems triggered en masse. Huge volumes of futures were automatically sold, and stock prices began an uncontrollable freefall. The New York Stock Exchange's systems also reached their limits, and trading was on the verge of paralysis. Everyone could only stare in bewilderment at their screens. In response to this unprecedented situation, Fed Chairman Alan Greenspan issued an emergency statement, pledging to supply liquidity to financial institutions. However, markets worldwide were already cascading downwards. The panic spread across borders, from Hong Kong to London to Tokyo. In just a few hours, the illusion of the boom era that everyone had believed in was shattered, and the global economy suffered a major blow. Black Monday taught us that technology is a double-edged sword. While increasing efficiency, it also amplifies unforeseen risks. It also showed us that markets are unpredictable entities, where human psychology and system logic interact in complex ways. Overconfidence in systems always carries the risk of unforeseen consequences. The same holds true for modern AI and algorithmic trading. Black Monday offers us an enduring lesson on how we should approach technology and understand markets. The collapse was brought about by a complex interplay of factors: overconfidence in technology, human psychological panic, and changes in market structure. What was overlooked was the self-amplifying runaway risk inherent in complex systems and the cascading impact it could have on the market. The lesson for today is that, with AI and algorithmic trading being prevalent, we must understand their essence, constantly monitor them, and never forget human judgment. The quality of decision-making in a crisis will differ significantly between those who understand this failure and those who do not. If you found this video insightful, please subscribe and hit the like button. We release a new history of failure every day. Stay tuned for the next History of Failure.
この失敗は歴史のほんの1ページ。世界にはまだ語られていない失敗が数多くあります。失敗の歴史をチャンネル登録して、次の物語もぜひご覧ください。